Hello, and thank you for joining us. My name is Adam Morgan, and the other face that you see is that of Deeds Kienker. Deeds and I are members of the investment team at Investors Trust Company, and today we'd like to talk to you about fixed income. I've asked Deeds to join me because he's our resident fixed income expert, and I thought I would pose a couple of questions to him today that a lot of investors have been asking over the past year or more regarding interest rates and fixed income. So as a backdrop, let's begin by taking a look at the path of interest rates in the United States over the past few decades. I wanted to start with this slide because whenever you're able to identify such a definitive trend in finance and one that occurs over such a long period of time, it tends to be meaningful and impactful. In this case, you can see that interest rates per the US 10-year Treasury have been coming down since their peak in the early 1980s. This particular chart shows the yield on the US 10-year Treasury note since 1991. Why is that important to investors? Well, what many of you already know is that in years past, as you were nearing retirement, investment advice was simple. You sell stocks, pay the capital gains tax, buy bonds. As was typical, the bonds would pay a relatively high rate of interest. And, oh, by the way, the value of those bonds held up or even increased as interest rates continue to drop over time. Today, we find ourselves in a very different scenario, and one that we're likely going to be dealing with for quite some time. The rate of interest paid on fixed income securities is low, and investors are struggling for a way to generate income. While there are some other options regarding real estate-based securities or stocks that pay higher dividends, today we want to focus solely on the fixed income side of the portfolio. So with that in mind, Deeds, would you mind explaining to our viewers what are some ways to generate income in a bond portfolio?
Yeah, sure. You're exactly right, Adam. It's a very challenging interest rate environment, to say the least, given that interest rates had already been trending lower for so many years, as that first chart really exhibits. And then you throw on top of that, coming into 2020 with the pandemic and recent actions taken by the Federal Reserve to help stimulate the economy. So you end up in the situation we're currently in, where U.S. Treasury yields across the maturity spectrum are near their all-time lows. Let's take the 10-year Treasury note, for example. It's currently trading at about 0.65% this morning. That's extremely low from a historical standpoint. And even from a recent historical standpoint, given that just a year ago, the 10-year Treasury note was yielding about 1.5%, and 2 years ago, it was north of 3%. That's a drastic drop off in the yield you're getting from a 10-year bond. So in this low rate environment, how do we produce more income in an investor's portfolio? One of the primary ways we do this is by investing in other sectors of the fixed income market, which tend to offer higher yields and have historically generated greater returns in government bonds. You can see this clearly in the chart we have displayed on slide 3, which plots the 10-year and 20-year annualized returns, as well as the current yields for a sample of fixed income sectors. And I've included here municipal bonds, investment grade corporate bonds, and emerging marketing debt, high yield corporate bonds, just as a small sample size to demonstrate the point here. The trade-off, which really is the core principle of investing in general, is that if we want to capture higher yields and potentially higher long-term returns, we must assume a greater degree of risk. And more specifically, when we're talking about bonds other than US Treasuries, this is credit risk. Credit risk is basically the likelihood that a bond issuer fails to make interest and principal payments to investors. We don't have this problem with Treasuries because they're backed by the full faith and credit of the US government. So they're essentially risk-free securities. But as we move from left to right on this chart into different sectors, we tend to assume a higher degree of risk. And in return, we're compensated with generally higher interest rates. I'll give, let's take investment grade corporate bonds as an example. These are bonds issued by highly rated corporations. And by this, I mean corporations with a credit rating of AAA, AA, single A, and triple B. These credit ratings are at the top end of the credit rating spectrum. Even with highly rated bonds, there does tend to be a relatively low risk of default with these investment grade corporate bonds. And to quantify this, if you look at the long run, the average 1-year default rate is well below 1%. So it's basically meaningless, even though there technically is a little bit of risk there. But we can get a nice bump up in income compared with owning treasuries. And so we think this is a very attractive risk-reward trade-off. To sum things up, in general, by having an allocation to higher yielding fixed income, we're able to maximize current income and minimize principal volatility while at the same time emphasizing long-term total returns for our clients' portfolios.
That's great, Deeds. A lot of clients ask, look, with interest rates so low, they're likely to go up or they can only go up from here. Why even own a bond in a portfolio? Why not own a stock that pays a good dividend and maybe take my stock market return for a few weeks and make more money? Why even own fixed income in a portfolio?
That's a great question. In fact, that's a question that investors have been asking for many, many years. Despite rates fluctuating up and down in the short run, again, going back to the first slide that we showed, over the long run, it's been a long-term gradual trend downward. And so investors have always really asked that. But that question is especially at the front of people's minds these days, given that rates are at their all-time lows, as we've talked about. So despite the low interest rate situation we're in right now, we still think an allocation of fixed income is very, very important for a lot of folks, especially for those who are in retirement, nearing retirement, or may have substantial short-term cash needs. That being said, there's really 4 primary reasons why having an allocation of fixed income is very, very important. Number 1 is income, which we've already talked about this. Receiving a predictable stream of interest payments is still a very, very attractive proposition for a lot of investors. Number 2 is protection of principal. Given that an investor's original principal investment is returned to them at a bond set maturity date, bonds by definition are a great store of value. And closely related to this rationale is reason number 3, which is liquidity. So because bonds tend to be a great store of value, they also act as a great source of raising cash, especially during times of market stress when the valuation of equities is plummeting. And finally, we come to reason number 4, which is diversification. A lot of areas of the fixed income market have a very, very low correlation with stocks. And so this characteristic allows the asset class to really serve as a ballast or an anchor and limit the decline of an investor's total portfolio when there's a downturn in the equity market. As an example, we've got a nice graph on slide 4, which plots the year-to-date total performance of 2 sample portfolios with the same initial portfolio balance as of January 1st of this year. As you can see, the orange line represents a portfolio with a 100% allocation to stocks. The blue line represents a portfolio with a 50% allocation to stocks, but also a 50% allocation to bonds. And as you can see, at the depths of the stock market crash that we recently experienced earlier this year, the investor with a 50-50 allocation only saw the value of their portfolio decline by 15%. As opposed to nearly 31% if they had been 100% invested in equities. Again, we think fixed income is very, very important for a lot of investors, and this type of downside protection is an attractive benefit for those with short-term time horizons and or short-term cash needs.
It's unbelievable to think, with all the market volatility, with all the manipulation of interest rates from the work that the Federal Reserve is doing, that at this point in the year, looking back, a portfolio entirely comprised of stocks and a portfolio comprised of 50% stocks and 50% bonds would yield such similar returns at this point.
That's right.
Just amazing, just with a lot less volatility.
Exactly.
Well, that's great. Thank you very much, Deeds. If you've seen anything in this video that sparked an interest or a question that you may have regarding how to generate income in a bond portfolio or how to limit volatility in your portfolio as you're nearing retirement, please feel free to reach out to us directly. You may call me directly or reach out directly to your wealth advisor. Thank you very much and stay safe.
Take care.